Welcome back, you legends. I'm Dr. Cal. This is going to be a really nice one, so let's get right into it. So the stock market had a bit of a mixed reaction yesterday, right? With the S&P and Dow both down and the Nasdaq up. If we actually take a look at the stock market map, we can clearly see the stock market really sliced into two: big cap tech leading, Microsoft, Apple, Nvidia, Google, Meta, Amazon. Those stocks are trying to hold the market up when everything else is collapsing, even defensive healthcare. So that's quite a surprise. And if we take a look at the relative performance again, look at this: big cap tech leading, everything else declining. So what's been going on? Well, we had Meta earnings post-market yesterday, and the stock rallied by 12%. I put out a note yesterday about Meta earnings. It's quite shocking, guys. Revenue was up 3%. That's a tiny sliver of growth, guys, in comparison to the historical performance of the company. And more worryingly, guys, costs are up 10%. So costs outpacing revenue is bad news. It's always bad news. What's worse yet, guys, that net income is down 24%. Now, keep in mind that the definition of an earnings recession is a 20% contraction. So Meta satisfies this definition. Operating margin is down 6%. Keep in mind, guys, that operating margins are usually reported in basis points. If a company makes, let's say, a 10 basis point improvement quarter on quarter, that's considered a really good improvement. So a 6% decline is really insane. So overall, the earnings report is terrible. Unsurprisingly, guys, post-market, Meta has actually rallied to its full upside target of 230. And why do I say that? This tends to happen when the market begins to roll over. And I'll show you an example, guys. Now, this is Meta, and the expected move was between 190 and 230, and we got all the way up to 230. And why is this an important level? And really, the rally, this entire post-market rally, is entirely mechanical in nature, entirely technical in nature, and it has to do with this, guys. There's this gap that's been left since April of last year. And in fact, I pointed out this gap 3 months ago as we entered the new year. I actually pointed out this exact gap, this exact target in the trading community, and we finally hit it. We finally hit it today. And in fact, I expect extremely limited upside from this point on and risk to be skewed significantly to the downside for the remainder of the year. So the earnings report, even though the company beat, the actual expectations were very bad. They were horrible, actually. So the company lost more than 20% of income, and yet it beat. So the expectations going into the earnings were already very bad to begin with. So it was very easy for the company to beat. And even though with the beat, the company actually lost, again, more than 20% of income. Whenever a company loses 20% of earnings, that's an earnings recession. So we're beginning to see that with Meta, and we will likely see more of that as we get into the second half of the year. Now, Microsoft reported a day earlier, and again, same thing with Microsoft, guys. Microsoft has finally completed its full measured move. Now, I had this full measured move target on the chart for well over 3 months now, since we put in this double bottom. You can call it really a triple bottom, a multi-bottom, double bottom, whatever you want to call it. But we had a very clear neckline here. We had the lows here. If you measure from the bottom all the way to the neckline and you multiply that by 2, you get the full measured move. And we finally got that yesterday. Another chart that I want to talk about is Amazon. Obviously, it's going to report later today. And I put out a note just half an hour ago. I wanted to talk about a couple of things. The first thing, guys, is that the expected move is $7 in either direction. And that puts this gap at 115 within reach post-market today. And again, if Amazon follows Meta's mechanical reaction, we will very likely see that gap filled. I wouldn't be surprised if we actually overtake that gap and even go to 120, this prior level of resistance. So this entire red box here. And again, very likely the top for the year for Amazon, Microsoft, Google, Apple. All of these companies, we're likely seeing the best earnings report this year for all of these companies come out this quarter. And now imagine if Meta's best earnings report is a decline by 20%. that already sets Meta up and all of these tech companies for failure in their upcoming earnings reports in the remainder of the year, especially as the economy continues to slow down in the back half of the year. Now, I also want to mention something very interesting, and it refers to another note that I put out today, and it has to do with money flow. If you notice, guys, behind this entire period of choppy trading, smart money flow has actually been picking up. So somebody knows something and has been buying Amazon throughout this period of weakness. And that again tells me to keep an open mind for a mechanical reaction to the upside, even if Amazon disappoints. By the way, guys, this is the Money Time Machine Smart Money Flow Indicator, and I put out a tutorial yesterday on how to use this indicator. This is my own indicator, guys, and I combined two things to really create this indicator, and it has to do with momentum and smart money flow, combining the two to reveal to us very clearly a lot of hidden trends, including this hidden trend. This hidden trend shows that smart money has been buying Amazon. And if I actually go to the weekly chart, it's way more pronounced. Notice how smart money outflows have actually bottomed here in November, October of last year. And smart money flow has actually been rising since. And again, that's a hint that investors have actually been buying, scooping up Amazon shares ahead of this earnings report. Just keep in mind, everyone, that earnings are always binary events and there are no guarantees. So there's absolutely no guarantee that Amazon rallies or crashes or anything really. But we can use information including technical indicators as well as identify hidden trends to just give us a probability edge. It's nothing more than that. It's just talking about probabilities. Now let's take a look at the S&P 500. And if you remember, guys, in my last market update video, I talked about how smart money was actually fleeing stocks at light speed. I published that video here. And really, the market topped very soon after that on April 18th. And we've been selling down since. Now, the downtrend did actually begin right here at the break of the 9-day moving average. If you notice, guys, after every single break of the 9-day moving average, which is this teal light blue moving average that switches to orange when price action is trading below it, whenever we break this moving average and follow up with a close below the 20, which is the dark red moving average, this line here, whenever we get that, we get a reversal of trend. It happened here in mid-February. It happened yet again here in early December. Then again, it happened in August of last year. And again, it happened in April. So systematically, guys, whenever we break the 9-day moving average and follow that up with a close below the 20, we usually get, guys, a period of consolidation, a backtest of the 20, then continuation of the selling, consolidation, backtest of the 20, continuation of the selling, consolidation. In this example, backtest of the 20, continuation of the selling. And so right now, guys, we will likely see a period of consolidation, weakness to consolidation, then a backtest of the 20, rejection, more selling, and that will likely send us back to 395 to fill this gap left from late March. That also puts the 200-day moving average within close proximity for a nice backtest. So we will likely see a backtest of the 200-day and a gap fill. Now, guys, I'm not entirely convinced that this sell-off will actually begin the waterfall style crash. I actually think we will get a high that overtakes this prior high in January, and we will likely complete a 3 drives at a high for the final top. Okay, so this is likely just a pullback within this final wave that will very likely bring the high for the year, and I suspect that's going to be right around these highs in August. The market is going to have a very hard time taking out this prior high from August, and that will likely put in the final high for the year and sets us up for a significantly more negative back half of the year for a continuation of the bear market. Now let's take a look at the hourly chart for the S&P 500. Again, this is a proprietary chart that I share with the trading community. You can get a live link to this exact chart setup with all of the levels and the gap fill areas and the price targets in the trading community. Check out the link in the description below if you're interested. And so what did we have recently? We had this gap filled at 407, this gap again at 403, finally filled, and we have one more gap that we will likely fill very soon before we get a rally, back test and failure that will send us back down to finally fill the gap at 395. That will likely be the low. In my opinion, I think that's going to be the low in the short term, setting us up for a continuation of this move up to 430 and the final high for the year. So let's remove these gaps. These have already been filled. Now, notably, guys, we had a break of this ascending trend line back here on April the 20th. Let's take a look at the daily chart. This is April the 20th, guys. Here it is. We had a break of the lows for the first time. Then we formed a bear flag formation. This is the flag pole. This is the flag. And we ended up breaking with significant volume and ferocious volatility to the downside. We will now very likely, again, guys, see some choppy trading on our way to fill the gap at 401 right here. And that will serve as very likely, guys, a launching pad to get a backtest of the 20-day moving average, a rejection, and then we could continue to move down to fill this gap of 395. Now, on the hourly chart, everybody, a telltale sign of a change in trend. The first sign is going to be a break of support. We had that break of channel support. The second sign is going to be this medium-term moving average, the blue line, crossing below the slow-moving average, the purple line. We got that a couple of days ago, and that confirms that the trend has changed. Now, rallies will be sold instead of the dips being bought, right? So we switch from buying the dips to selling the rips. You get a rip, you sell it. You get a rip, you sell it. And that's going to favor the sell side until this downtrend ends. And it will likely, guys, take a couple more weeks for this entire downtrend to end. Remember that next week we have even more earnings and we have the Fed meeting. So more volatility ahead, and this gap at 395 will likely take some more volatility to get filled. So I'm expecting price action will hold above this gap until we get big earnings from, let's say, Apple, as well as the Fed meeting next week. Now let's take a look at another chart here, guys. This is the high-low index. Below, up above is the PPO, which is a variation of the MACD. Now, I wanted to talk about this chart because there are some very clear structures that I want to mention. The first is this descending triangle, and we had a break above resistance back in January. It led to a lot of FOMO, and we warned that this is going to be a major trap for the year, and it ended up being a major trap because we actually never got back to the prior high post-Fed meeting in early February. We went back down, took out this prior support line, and went all the way to the 200-day moving average, dipped below it briefly, then recovered. Now, the recovery has failed at this prior support line, now acting as resistance. And it shows that further rallies are going to be weaker from this point on, guys. So even though I expect this wave to take on one more push to the upside, all the way back to 4,300 on the SPX, I still expect this resistance line to hold and for the market to find the final high for the year around this level. Now, I also want to point out a few critical really differences here. If you notice, guys, the PPO has actually produced a bearish divergence, putting in a lower high here, while the high-low index has done the same thing, putting in a significantly lower high here, and is about to go from green to red. Usually, guys, when we go from green to red, we get further weakness, further weakness, further weakness. The exception was March. And that's because, guys, the switch from green to red happened very late in the cycle. If you notice, the PPO has actually produced a bearish cross at least 3 weeks ahead of this switch from green to red. So this signal was late in March, but right now we're actually coming down from a very low level to begin with. And so the switch is going to take place earlier in the cycle. And that means that I expect even more weakness to come. As I pointed out, I think we will go back, test the 200-day, fill the gap at 395, and likely find buyers at that point. Now let's take a look at the BPSPX and the Money Time Machine Smart Money Flow. Let's take a look first at the BPSPX, guys. The BPSPX has put in a negative divergence. I actually talked about this in my last video, and it marked the high perfectly. Exactly to the day it marked the high. Then we had a cross below 60, and usually, guys, a cross below 60 leads to further selling in the S&P 500. This has happened systematically. We're now actually back to the extreme lows. We're still rolling over, although at these extreme lows, again, I expect more chop here before we fill the gap at 395. Smart money flow has been declining, guys, since the beginning of the year, and this is no different to what we've seen with smart money selling these rallies and dumb money buying these rallies. So both the BPSPX and the Money Time Machine Smart Money Flow Indicator, both of these indicate more weakness to come. By the way, guys, these red and green dots, these are buy and sell signals. Notice here the sell signal came in exactly as the market began to form this bear flag, and then we got significant weakness follow that. This sell signal again was put in as the market was forming this bear flag, and we got even more weakness follow that. This buy signal, guys, actually caught the low, and this buy signal did the same thing. It caught the low of the cycle. There are conditions to using this indicator, guys. Please check out my tutorial if you want to learn how to use this indicator. By the way, guys, this indicator is totally free to all community members. If you sign up for any of the legendary memberships, you automatically get free access to this indicator. Now let's take a look at the HYG, the high yield bonds. Again, high yield bonds have actually been holding up significantly better than the S&P 500. And this sets us up for a counter trend rally, a recovery here. Again, for a back test of the 20-day moving average before we move lower. Because high yield bonds have been holding up, they've actually put in a positive divergence, a bullish divergence. That tells me that this sell-off will be preceded by buyers stepping in. However, once the earnings season comes to its conclusion, the reality will set in that these valuations really make no sense. Now, imagine that you want to deploy new capital into the market. Would you start buying Meta at this level? It makes really no sense at this level. It makes no sense to deploy new capital at resistance in Microsoft. And it's the same thing, guys, across the board with Apple, with Google, with all of these tech companies. They're rallying into resistance post earnings, and that sets all of these stocks up for significant downside. That's what the market likes to do. It likes to flush out all of the options positions ahead of a big down move. And when you get a big gap up like this post earnings, you flush out all of these puts, put premiums collapse, and then bears can actually short the market at very low cost post earnings. Now, high yield bonds, guys, tend to give us little hints of short-term market direction, right? Bullish divergences like this tend to result in quick rallies. Again, bullish divergences like this tend to lead to quick recoveries, and bearish divergences like this tend to lead to market tops. So we already know that the market top has been established. What we are now anticipating is a quick bounce back coming in probably soon here for a back test and more commitment by the bears to push the price action back down to fill the gaps below. Now let's take a look at my bond market risk appetite indicator. This is my own indicator, guys, and I look at bond market risk appetite to assess whether the market is actually bullish, medium term, or bearish, or whether the market is beginning to roll over or reverse. And notice we have a bullish divergence here. This is the S&P 500 in blue and black, and has put in a lower low versus the April highs, while the bond market risk appetite has actually put in a higher low. And again, this tells me that short term, the market actually wants to recover. Now let's take a look at the VIX. Same story here with the VIX, guys. We had a break here and we ended up making a lower high versus these prior highs here. And then we got a rejection followed by another rejection yesterday and an indecision candle. And we're now seeing volatility decline, and this favors again a short-term recovery in the S&P. Let's take a look at the Nasdaq now. The Nasdaq has actually been putting in higher lows, even though the S&P has been putting in lower lows. So even though these earnings results have been very disappointing, the bar has been set very low that even an earnings recession is now beating, quote unquote, the street consensus. And so you're seeing Johnny come lately bulls actually buying this dip, leading to a short-term recovery here that is going to be bound for failure. Again, risk appetite is telling us that money will buy these dips, but that these dips and this upcoming rally, this upcoming bounce will inevitably fail and push price back down. If we take a look, guys, at the Qs divided by the SPY, so the Nasdaq relative to the S&P 500, the Nasdaq relative to the S&P has actually been improving slightly here as of late. The PPO has been curling over the zero line. So actually this sets the market up for Nasdaq, for the tech industry, to continue to lead the market slightly up here as the rest of the market continues to decline. I'm talking about financials, those regional banks that have been collapsing left and right, energy stocks, basic materials, you name it. All of these stocks are actually now topping and declining. And now tech is beginning to pick the pace back up to continue to lift the S&P 500 to keep it afloat, at least for a little while here before we put in the final top. Now, guys, very likely, actually, we will see a lower high on the PPO coming up in, let's say, the next couple of months here. As the Nasdaq puts in the final high, we will likely get a double top on this ratio chart with a lower high on the PPO, and that will establish the final high for all of the Nasdaq, especially the Nasdaq 100, and that again will very likely come in at the 430 level on the S&P and give us the final high for the year and the next sell-off in the back half of the year. Now let's take a look at the Dow Jones. By the way, guys, if you found this video helpful, just smash the like button while you're watching. The Dow Jones has been actually doing something very suspicious, very sneaky here. Notice, guys, this trend line, this resistance line. It held once, twice, 3 times, 4 times, actually multiple times here. Then we had a false break recently. We held it briefly, and then we had a waterfall sell-off as soon as those regional banks began reporting earnings. And now the Dow Jones has actually been leading the S&P down, and the Nasdaq is beginning to pick the pace back up, which is the opposite of what was happening leading to this sell-off, where the Nasdaq was weakening and the Dow was leading. We're now seeing these roles getting reversed, right? We're seeing the Nasdaq now picking the pace back up while the Dow Jones decline. And this rolling market behavior, where we roll from tech to industrials back to tech, has been the sole reason responsible for the S&P 500 not taking out the December lows. Because, guys, the Dow Jones has taken out the December lows. The Russell 2000, so the small caps, have also taken out the December lows. The S&P 500 hasn't quite done that yet, and we will likely see that come in the back half of the year when we put in that final top as the reality sets in post earnings. If you are an investor and you've been holding on to these tech stocks that have led the market throughout the rally since October, you'd be looking at very limited upside, very high risk environment. You are up a lot, you will likely take profit. That's what the vast majority of money managers have actually been doing. The dumb money has been buying these rallies recently, while the smart money has actually been using these rallies to unload, to unwind positions. That dynamic, guys, will likely continue into the summer as we get that final high for the year. So let's take a look at the Dow Jones Industrials up top and the Dow Jones Transports down below. This is the Dow theory model, and we use this model, guys, to identify bullish and bearish divergences. For example, this bullish divergence allowed us to identify the low in December and the beginning of the rally early this year, right? The Dow Jones transports tend to lead the Dow Jones industrials. This is another example, guys. The Dow Jones industrials have been putting in lower lows here while the transports have been putting in higher lows. And again, that allowed us to catch this upswing, this counter trend rally, and make a decent profit on it in early March. What we're seeing now is a couple of divergences. This is the first bearish divergence here, guys, where we had a lower high while the Dow Jones industrials put in a higher high. This actually marked the high on the Dow Jones perfectly. The Dow Jones actually topped here, has been moving sideways right up until it broke down recently. And we're now seeing another significant bearish divergence, and it's this. The Dow transports, which lead the Dow Jones, have actually taken out the prior the prior lows from March, while the industrials haven't quite done that yet. And that sets the Dow Jones industrials up for more downside, significant downside. And this makes a lot of sense looking at the macro environment. If you look at the macro environment, guys, we're clearly seeing so many signs of the economy slowing down. So what you'd expect is the transports rolling over first because these, again, are leading. And then you expect the Dow Industrials, the overall Dow Jones, to come and follow the decline, the weakness in the transports. The transports, guys, are trucking companies, airlines, postal services, land and sea freight, trains, all of these. This is the backbone of the economy. Whenever there's heightened economic activity, you expect the transports to go up because whenever there's a lot of economic activity, a lot of buying and selling, there's a lot of exchange of goods, and these goods need to be transported. And so when you see the transports declining, it indicates that yes, economic activity is slowing down. There are fewer and fewer goods being exchanged, and so the demand for these transports decline. That serves as the first warning sign that yes, more weakness is coming. Another indicator that I watch, guys, is the copper to gold ratio. We call copper Dr. Copper for a reason, and it's the same story with the transports. You expect copper demand to go up when the economy is accelerating, when the economy is gaining traction, because copper is used in everything, right? It's used in making electronics, it's used in buildings, in construction, thousands of industrial processes, and so copper prices tend to be early warning signs of an economy that's slowing down. And if you notice, guys, there's a huge negative divergence here where copper has actually made a significantly so much lower than the S&P, a much lower high than the S&P versus the high in February. Notice how the S&P has actually been mostly flat versus February, slightly below the February high, while copper has actually fell off a cliff. And all of that with the PPO below the zero line and with an obvious bear flag structure here. And the same thing here, guys. We had a bear flag that broke recently. And again, it tells us that the economy is very weak. We had the same look, guys, all the way back in late 2021, early 2022, when the S&P put in its final high. This is, in fact, guys, one of many indicators that is showing very similar signals to the high back in late 2021, early 2022, the all-time high for the S&P. In fact, we have the exact same look from the VIX. Now, guys, if you remember, I talked about the VIX giving out a very clear bearish signal of complacency, warning that investors are being very complacent here, where the VIX went all the way down to the lows that we haven't seen since the all-time highs. These are the all-time highs. The S&P is at 410 or thereabouts. And the VIX is lower than when it was back here when the S&P was at 480. So this is a huge warning sign. There's so much complacency. And we're getting the same look, guys, from the Dow Jones transports, right, guys, showing this massive negative divergence. As the S&P and the Dow were putting in their final high, we had this massive divergence here. And we're getting the same thing here, guys. We will likely see the final high come in very soon here in the S&P and the Dow as the transports continue to form this massive divergence that looks eerily similar to the all-time highs that we saw back in early 2022, late 2021. For a new money investor looking to deploy capital, it really makes investors think once, twice, 3 and 4 times before they deploy their hard-earned capital into these markets. And that's why we saw the smart money selling these rallies while the dumb money, and it's, by the way, guys, it's called the dumb money because it's fast money. It's not really dumb or smart. It's not about intelligence or IQ. They don't actually measure the IQ of the money. What they do is they look at two things: the size of the account, so larger account, multi-million dollar account. Multi-million dollar accounts are considered smart money, and they look at the frequency of trading. If you trade very selectively, going in and out very selectively a few times a year, that is considered smart money. Because smart money doesn't really tend to trade the choppy trading, all of these ups and downs. It tends to buy at the very lows and sell near the very highs. Now, another key chart, guys, that really every trader and investor needs to take a look at on a frequent basis is the ratio chart between consumer staples and consumer discretionary. Now, this chart, guys, divides the performance of consumer discretionary by consumer staples. And when this chart is expanding to the upside, it indicates optimism and the strength of the American consumer. And when we see this ratio chart beginning to put in lower and lower highs, it indicates that the consumer is actually weakening and consumer discretionary stocks weakening. And that tends to happen when the economy is slowing down, and that tends to lead the market down lower. Now, another indicator that I actually added to the trading community is the value line. The value line indicator, guys, comes into two variations: the arithmetic version and the geometric mean version. Now, I will not go into too much detail here, but this indicator, guys, gives us a much better look at the health of the overall market because it includes 1,700 components assigned an equal weight, okay? While the S&P 500 is based on 500 components that are weighted based on their capitalization, based on how big the company is. So a handful of big companies like Microsoft, Apple, Google, Amazon, Meta, etc., they have an exponentially larger effect on the S&P 500. And they do not really reflect the health of the overall market, because these are just a handful of companies. And if you remember from my last video, only 8 companies in the S&P 500 were responsible for over 80% of the returns year to date. Just 8 companies. And that's another example, guys, of how the S&P 500 can be misleading, of how really these big indices, these cap-weighted indices like the S&P and the Nasdaq can be misleading. Now, if you take a look at the value line index, notice this massive negative divergence between the highs in November of 2021 and the all-time highs. Remember, this is the all-time high, the S&P 500 in late 2021, early 2022. Notice how the value line index actually put in a lower high, while the S&P put in a higher high. A massive negative divergence is actually now developing. Notice the same look, guys. This is the same look. We have a massive negative divergence, significantly lower high on the value line index versus the S&P 500. Now, I suspect this divergence is going to get so much worse here, guys, an even lower high, while the S&P goes on to make one final high, again, to put in the final high for the year around that 430, 4,300 mark on the SPX. So again, we're looking at the upside potential shrinking and the downside potential expanding significantly. We are essentially here, guys. We are essentially here. This is an equal high that the S&P put in December. This is pretty much an equal high. We are essentially at this point. We have one final leg up, in my humble opinion, to complete the 3 drives at high. This entire move, in my opinion, is just a single wave, right? That's going to produce the final high for the year, just like what we saw back in early 2022. And I suspect that this is going to happen in the summer. Again, the value line index is likely drawing a very similar parallel to this period back in late 2021. So we might see one final push up, or maybe even a lower high. In either case, I expect this divergence to lead to significant declines in the back half of the year, as all of this earnings optimism, as all of these big cap tech companies with really absurd valuations, Microsoft 30 price to earnings ratio, Apple the same thing, Nvidia 150 times earnings to price. Absolutely nuts, guys. These valuations make no sense at an environment where we have interest rates at 5%. And as long as the Fed maintains interest rates in this vicinity for the remainder of the year, valuations, even if earnings remain resilient, valuations have to come crashing down. And this tends to happen in every earnings cycle leading into recession. We finally get the equity risk premium rising. And the equity risk premium, guys, looks at the risk premium that you should be getting as a stock investor versus investing in bonds. And so when bonds are giving you these really attractive yields in the 5% range, you expect to get significantly better returns out of your stock position, not these crazy valuations at 30 plus price to earnings ratios. And remember, guys, PEs, price to earnings ratios for stocks, are equivalent to yields on bonds. And so when yields on bonds are very attractive, you expect price to earnings to become attractive. That can only happen through 2 ways. One, an expansion of earnings, and we're clearly seeing that's not happening. We're seeing earnings decline. And so you would need prices, stock prices, to come tumbling down significantly lower from this point on for the equity risk premium to actually just go back to the historical average, let alone to the levels that you would expect ahead of recession. Now, take a look at this chart, guys. The equity risk premium is less than 2%. And leading into recession, including the 2020 recession and the 2018 China and US trade war, the equity risk premium almost doubled, and then it doubled again during the pandemic. And if we actually, guys, take a look at the historical data, notice this. The equity risk premium currently sits at 1.6 percentage points, the lowest level since October of 2007. Now, this is shocking because what was happening in October of 2007? The S&P 500 was putting in its final high for the cycle, for the entire cycle. Here it is, guys. This is October of 2007. This was the final high, the final top in the entire economic cycle leading to the 2008 recession. We're now seeing the equity risk premium at the exact same level. This means that returns on the stock market are going to be significantly worse from this point on. And again, risk is going to be skewed significantly to the downside. And usually, guys, at these points in time, money tends to flow out of the stock market and into safety assets like long-term treasuries and like gold. And if you remember from my last video, inflows into money market funds, which are cash equivalent funds. These are funds that provide yields, very attractive yields on cash positions through very short-term debt vehicles. Inflows into these funds have been absolutely exploding. And that means money is not going into stocks. It's actually going into cash equivalent, very short term, very low risk debt vehicles because yields there are very attractive and the risk is very low, while as in the stock market, risk is very high and yields, the equity risk premium versus bonds, is very low at these levels. If we also take a look, guys, at the Money Time Machine proprietary put to call ratio buy and sell signal, we actually got a sell signal yesterday. Finally, a confirmation signal. And again, guys, these sell signals always tend to lead to more weakness. Look at this. This was the first sell signal. When we got more sell side activity, more weakness. And again, in February, the same thing, more weakness. Same thing after the August highs, more weakness after the same sell signal was triggered. The summation index again crossed down, is pointing down, and again the summation index is the gold standard indicator to identify trends in the market. When you get a cross up, we get a nice uptrend. On a cross down, we get a downtrend. Cross up, uptrend, a cross down, a downtrend. Up top, guys, is the New York Stock Exchange, and below that in blue and black is the S&P 500. And clearly we can see that the summation index tends to indicate that we are going to see more weakness, more sell side activity ahead for the S&P 500. If we take a look at the Nasdaq Composite Summation Index, same thing here, guys, rolled over, barely moved up, then rolled over recently, indicating more weakness. Now, I did go and look back. I wanted to see when was the last time where we had a big thrust up, a failure, then a bear flag structure, where we had a pull and a bear flag. Now, funnily, guys, the last time that happened, you will not believe it, it was back at the all-time highs. We had this rally, then we went back down, had this weak, meager recovery, bear flag, and more weakness. And actually the market was putting in its final high for the year, the all-time high, in fact, at that point. If we take a look at the S&P 500 50-day breadth, again, we got a sell signal yesterday. Again, these sell signals tend to lead to more weakness all the time. 200-day moving average breadth, which looks at stocks in the S&P 500 trading above their 200-day moving average. We're now at less than 46% of stocks trading above their 200-day moving average. And again, every time we had a rollover of this indicator, we had more weakness come ahead. In terms of economic events, guys, we actually just got the GDP growth. It is significantly lower than expected. The actual is 1.1, much lower than 2.3, which was forecasted, and the consensus was 2%. Now, worse yet, look at this, the GDP price index, so inflation, is higher than expected. So growth is half the expectation and inflation was higher than expected, and even higher than the prior quarter. So this is a very clear signal that we are in stagflation, a stagnant economy, barely growing, and inflation remaining very high. Take a look at the fear and greed index. We are down from greed back into neutral. If we take a look at the timeline, the fear and greed index, guys, tend to mark stock market tops around the 75 reading. Again, this tells me that we will likely see one final push up higher after this correction and gap fill at 395 is done. One final push higher, that puts the final high for the year, and we go down from there. We have Amazon and Intel earnings coming out after the market closed today. So I'm going to be watching both of these. If you watch this video till the end, thank you so much. I really appreciate you. If you want to support the channel, check out the community membership in the link below in the description. If you found this video helpful, you can support me totally for free just by smashing that like button, slapping it on your way out. If you watched till the end and you did not enjoy the video, I thank you for your attention. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.